Good afternoon. Thank you for joining us today for your lunch hour for our Navigating the Home Buying Process webinar with an emphasis on how to obtain a home loan. I'm Corby Gage, the Executive Director of Coastal Housing Partnership, and with me today is Kim Pascage, our Program Manager for Coastal Housing Partnership. And today's webinar features 3 local loan officers: Kim Levitro from Dignified Home Loans, Austin Lamson from Homeowners Financial Group, and Cindy Nunez from Guild Mortgage. Appreciate you being here with us today. Cindy, Austin, and Kim are all part of Coastal Housing Partnership's network. And as part of this network, these lenders reduce the closing costs associated with obtaining a home loan for their clients who are employed by companies that are part of Coastal Housing Partnership. The format for today's webinar is I'm going to be asking Austin, Kim, and Cindy some questions about the process of obtaining a home loan and being ready to purchase a home. So the remainder of our time together will be for you to get your questions answered. We definitely encourage you to ask questions. We'll be recording today's webinar, so we'll send you a link to that recording at the end of our session together. So the webinar format means that your cameras are off and your microphones are off. So we can't see you or hear you. If you do have questions, please put them in the Q&A. And you can ask your questions anonymously if you like. There's an option for that. Feel free to put your questions in the Q&A at any time throughout the webinar. We will get to all of them at the end of our time together. It's important for us to address the issues that are important to you. So we want to make sure we have time for that. And then at that point, we'll have Kim, Cindy, and Austin respond to those questions. And you also can see all of their contact information here. So you can follow up with Kim or me or any of the 3 loan officers at any time after the webinar as well. So since the first step in the home buying process is meeting with the lender to find out how much of a loan you can afford, the information you're going to get today is going to be really important and going to help you be prepared to take that important first step in home ownership. So let's get started. Kim, will you share a little bit about yourself?
Yeah, my name is Kim Levitro. I work for Dignified Home Loans. I've been here 5 years. I've been in the mortgage industry since 1989 when I went to work for my stepdad. I started originating loans retail in 2007. And we've had the privilege of working with the Coastal Housing Partnership since 2019. So I am so glad to be here today and look forward to talking to everybody.
Thank you, Kim. Cindy, would you share a little bit about yourself?
Sure. So I'm Cindy Nunez. I am with Guild Mortgage. I've been with Guild for 14 years in the industry since 1986. Kind of like Kim, I think, probably have done a multitude of roles, underwriting, doc prep, funding, secondary marketing, and started originating in 2001. And I'm also manager for this office and have a great group of people working for me.
Great. Thanks, Cindy. Austin, would you share a little bit about yourself?
Of course, I'm Austin Lamson with Homeowners Financial. I've been in lending for 25 years and did have the honor of serving on the board of CHP for about 4 years as well. So it's a great organization. And I think what all of these ladies bring to the table is not only experience, but care. You've heard them talk about different parts of the industry that I've been in. I've been in operations as well, and that gives every single person on this panel a lot of perspective. So very, very grateful to be here.
Great. Well, as you can see, we have brought you a lot of expertise into this panel, and we're just so grateful that you're here joining us and sharing that information and helping to educate our attendees today. So thank you. Austin, let's start with you. I mean, the big question everyone wants to know always is, you know, when's the right time for a potential homeowner to go to meet with a lender? do they need to be ready to buy right away? Or, how long in advance do you, take to meet with the lender? If you think you're ready to buy, maybe in 3 years, should you still meet with them? What's involved in that process when you're going to meet with the lender? What's involved with the pre-approval? Just kind of paint a picture of what someone should expect and when they might be a good idea for them to meet with you.
Yeah, and it's a really good question. I think a lot of people get this like, well, when do I do it? When do I start? Right. And of course, all the lenders on this would be like, I don't know if I'm bugging you, but right. So first of all, if you've thought about buying a house, then you should really go talk to a lender, right? Because what you're doing is you're developing your team. There are so many different nuances, right? It's not just your credit score, it's the depth of credit. How do these things report? It's how is your money structured? You may need reserves, and it's not just the down payment. And so working with the right lender really makes sure that you have that good game plan, right? That you know what your life specifics are, that an online calculator or online click through to get a letter can't get you in order to get that next step. And especially here in that 805, we're a unique area, y'all. It's literally a different process than way down in Southern California. It's a different process than Northern California. So again, if you're like, I think I maybe want to buy a house at some point in time, maybe, then yeah, you should go ahead and get a meeting. And everyone's always honored to take those next steps with you. Right?
Okay, so you're not by going to see a lender before you're ready, maybe you don't even have your down payment saved or you don't have your credit in line. Is that something that the lender is going to be kind of not giving you the time of day on that, or are they going to be just as eager to work with you as they are as someone who's ready to buy tomorrow?
Well, it's definitely the wrong lender if they're not, right? Because again, the due diligence a lender does when they write that pre-approval letter, they're literally signing their name that you're going to make that payment, right? So, and how do we know to which level we need to get your credit if somebody doesn't look at it? How do we know to which level you need to save for having that down payment or the closing costs, right? So it's always good idea to get that game plan to talk about what is the most important thing for you. Is it the down payment? Is it the monthly payment? Is it a certain type of property that may be unique to qualify for? So you definitely want to get that game plan. Again, I think I maybe sort of want to maybe sort of buy a house. That means we definitely want to start considering. And one of the things that we get, Corby, is what is a pre-approval? Why is this important? So again, as I alluded to, it is literally someone signing their name. I promise, Cindy promises, Kim promises that you're going to make those payments to the full extent of our knowledge. We've done the due diligence. We've done all the homework. Yes, stamp it, sign it. I mean, let's be real. Let's PDF it now. It's because it's electronic, right? But a pre-approval is that commitment that you will make those payments. And it's super, super important because without it, the seller doesn't know you, right? They don't necessarily know if you're going to be able to close the transaction. This asset, this savings, this equity, their life that they're putting on the line to commit to your dreams has to have something behind it. And that's exactly what a pre-approval is. That pre-approval too, we got to remember Lone Land, the fabulous world that we all live in, has 4 building blocks: income, assets, credit, property. So the property is TBD. So that's 3 different parameters, and it's like a mousetrap, right? If your income switches here, then you need this down payment or you need that credit profile. So that pre-approval is not only the lender's commitment that it'll be done, but it's the how. And it's vetting those 3 concepts of that world, right? That credit, that income, that assets, the 3 big portions of your life to indeed, outside of the property, prove that you're going to get those bills paid and that you're going to be able to close that transaction and get the keys for the house.
Great. So that pre-approval, you're going to be giving someone an indication of the amount of loan that you would loan them and then what that would cost them on a monthly basis.
A monthly basis and at closing. It's very, very important that you know both. Like, as you mentioned before, what if they don't have their down payment saved for? Well, what if you have your down payment, but not your closing costs? How does that money go through? So any pre-approval is not a letter. It is a game plan. It is a strategic game plan for your life to get those keys, because we all know that acquiring real estate is one of the best way to build wealth in America.
Right. And so it's my understanding that a lot of real estate agents won't even work with you if you don't have a pre-approval, because you don't really know what you could afford. It's kind of a guess as to, can I afford a $500,000 condo or $750,000 home? You don't really know without that pre-approval. Is that your experience?
Correct. Some agents won't let you in the car, and it's not to be mean. To clarify, it's so that you don't cry. It's so that you don't fall in love with something that we're not quite there yet to obtain, right? So in order to get that pre-approval, again, you're working with a lender on a strategic plan. What is your down payment? What are your closing costs? Where are your monthly payments? And then from there, it's that good strategy to be able to acquire that property. And that's what that realtor needs. You don't want to make anyone a commitment that we can't abide by, right? And nobody wants to get your heart and your family's heart set on something and then to have that rug pulled out from them.
Great. Thank you. That's wonderful information. You referenced credit scores, Austin. Cindy, let's talk a little bit about credit scores. Why are they important? How is a credit score determined? Kind of what's involved in that credit score in terms of the loan process?
A magic question, right? So basically, your credit score is a numerical representation of your credit worthiness. So by establishing credit, monitoring your credit, and being disciplined with your credit, you establish over time a credit score. We use 3 bureaus as a mortgage company: TransUnion, Equifax, and Experian. And then we take the average of, the middle on the number line, right? So if you have a 640, a 680, and a 660, we're going to go with the 660. The better your credit is, the better your terms of your loan are going to be. So your loan approval and your interest rate are highly affected by your credit score. It's important to keep in mind also that the amount of debt you carry has a really large impact on what you qualify for. So what I like to say is, with interest rates where they are today, for $8 in a monthly payment that you have in debt, you've wiped yourself out of $1,000 in qualifying. So there's definitely a number for that.
So is it a good idea for someone to, pay off all their credit cards and pay off all their car loans before going to see a lender because of that debt? Or is it better to maybe work with a lender and figure out what to do in terms of getting your credit score into good shape?
I think if you're working with the right lender, they should see you before you start making any payments or paying anything off. A lot of times people will have a limited amount of debt and maybe a car payment, and then they go wipe out the car payment. And that's one of the key factors affecting their score in a positive way. So I like to look at everything, and any good lender would do this. Look at the overall picture. What type of debt do you have? What are your balances to the available credit? Are you carrying student loans? There's a lot of different factors that we look at when qualifying somebody for a pre-approval. So I think if you're with the right lender, you should meet with them early on, and they should tell you that.
Okay, so you don't need to be concerned about having everything buttoned up and perfect before seeing the lender. The lender's going to maybe give you that game plan to get the better score.
Right, and there is some misconceptions out there. I talked to a couple about 2 weeks ago. They carried 800 FICO scores, but they didn't want to talk to me until they were paying off all of their debt and getting rid of their son's car loan. And I was like, no, well, wait, let's look at where you are today by using a soft qual. And we'll talk about that a little bit later. And then I can give you an idea of what will be your best path.
Okay, so someone might be using up a big chunk of what could be a down payment by paying off all those credit cards.
Yeah, and we don't want to do that. We want to take a look at everything first.
Okay, so now the FICO score, the Vantage score, what's the difference there? Is that something that someone needs to know about?
It's a big difference. So many consumers today monitor their credit either through Costco or Experian. And those are consumer credit scores, which is the Vantage. They use different scoring models as opposed to the FICO, which is our primary scoring model. So somebody who has a really good Vantage score might not have a really good FICO score. So it's always important. You can't rely on those 100%, your consumer scores, because we are going to see different scores when we run your credit report.
Okay, so it sounds like it's a good idea to have the lender run your credit, but is that going to have a negative impact on your score?
One of the things that's changed in the last 12 to 24 months is the amount of leads that are being sold on the credit market. So basically, when a lender runs your credit, today, you immediately start getting robocalls from millions of other lenders across the nation. So what many lenders have done over the last 6 months is gone to what's called a soft qual credit report, where we can actually see your credit scores and your credit history without putting a hard inquiry. I think, ladies, you both do that. I do that, just to assure we start off in the right direction and they aren't bombarded with a million people calling them every day.
Great.
Also, one more thing I thought about, Corey, sorry. With the soft calls, we also have the ability to do what's called a simulator, and that will tell us how to efficiently and the most productive way to get their credit scores as high as possible. And that is not a cost to the consumer.
Well, that's a great service. Absolutely. So what if someone's had kind of a negative credit event, maybe a bankruptcy, a foreclosure, short sale? How long do they have to wait before they can become
Back in the market again?
get a home loan?
Right. So one of the good things is after 2008, a lot of people have recovered from that. If they did go through a credit event from a medical illness or something happened in their lives where they had financial trauma, there are waiting periods for different loan types. So with a conventional loan, a foreclosure is a hard 7 years. A short sale is 4 years, and a bankruptcy is, I think it's 2 years for a discharge Chapter 13, and it's 4 years for Chapter 7. I can answer more questions at the end if there are some for that.
Okay.
FHA and USDA are 3 years for a foreclosure, 2 years for a Chapter 7, and actually after a Chapter 13, if they've made their payments on time for a year on that Chapter 13 bankruptcy, they can qualify FHA. And then VA, foreclosures and short sales are 2 years as well as bankruptcy.
So it sounds like there's a lot of different options and parameters. It's a good idea to meet with the lender to find that out instead of just thinking there's a hard number in terms of number of years that you need to wait. So
yeah, and the important thing is, the important thing is to not be scarred by that. A lot of people go through that and then they never want to meet with a lender again because they feel terrible about what happened. I encourage everybody to reconsider their options. Like Austin said, owning a home is one of the biggest ways to build wealth today. So home ownership is never a bad option.
Okay. What about student loans? Do they count against your qualifying? What if they're in deferment? You know, how does that impact an individual buying a home?
That's a great question too. So a lot of people are in deferment on their student loans since COVID. And so they think that because they're in deferment that they don't have to be counted in their debt ratio, which is not the case. It would, no matter what loan type you're getting, except for VA is a little bit more flexible. We do have to count the student loan payments against our customers, regardless of deferment or not.
Okay, great. Well, it sounds like there's so much around the credit scores and that there's a lot of this information can be answered by the lender that you meet with, and that they're going to be a very helpful partner to you in terms of getting your credit score to a good, solid place to get the loan you want. Thank you, Cindy.
Yes.
Kim, so, you know, we're always asked, first-time home buyers, are there first-time home buyer programs? Who is considered a first-time home buyer? Are the home buyer programs income restricted, or, you know, how does someone navigate that process of finding out what's available to them as a first-time home buyer?
Well, you definitely want to talk to a lender because there are different roles for a first-time home buyer. Meaning you're considered a first-time home buyer if you haven't owned a home in 3 years. And, you know, if you had gotten a divorce and if you've waited the 3 years, you could go do a down payment assistance loan. But with Fannie Mae and Freddie Mac, if you recently have been divorced and you were on title, you will be considered a first-time home buyer if you're getting divorced. So that's a rule that a lot of people don't know. And they fall back on the 3-year rule. So you should definitely talk to somebody because we could look at your circumstance and make sure, you know, and make sure you can take advantage of what's out there. So, in regards to down payment assistance, I'm super excited because yesterday, CalHFA announced that they're coming out with their 20% Dream for All shared equity shared program. And that's going to go into effect March 27th. So what that means is buyers, it's an income-driven product, meaning your income cannot exceed certain guidelines for certain, for certain counties. We could go over that in a little bit, but it's an equity share and you'll get 20% towards your down payment. So I'm really excited about that. They haven't told us all the guidelines yet. Ventura County, the income limit is $228,000, which is $19,000 a month. Santa Barbara is $198,000 a year, which is $16,500. So what that means is everybody who is on the loan, your income cannot exceed that. Equity share, when you sell the home, you have to give back part of your equity. So I could go into detail if you want me to. Do you want me to explain that too?
Well, yeah, that sounds like some very generous guidelines in terms of income. So, oftentimes when we think about a first-time home buyer program, income restricted, we're thinking you can't make too much money and still qualify. So that's very encouraging to hear that. Sounds like you really, again, all of these areas, you're just going to find out so much more when you actually meet with the lender. The lender can match you with a product that works with you for you. They can help you with your credit. They get you pre-approved. That first step is so important. So it sounds like this is just one of the new programs, but there's a lot of other programs available as well, Kim?
There are. And if you have a down payment, there are standard products where you can put 3% down with Fannie Mae or Freddie Mac. You could do 3.5% down, for FHA. There's the Golden State product, which has their own set of guidelines, and I could go into detail on those. But yeah, there are tons of products. Don't wait, come meet with a lender, find out what you could qualify for. And if you do have to wait, knowledge is power. And talking to us, we'll make a game plan. It's when you've worked with people and then you work with their kids and then you work with their parents and their cousins, and that's the biggest compliment. We all work by referral. And I know Cindy and I know Austin, have worked with people's families, and you get to see them grow up, and it's a joy. We love what we do.
That's great. Well, makes it so easy to know that you're going to meet with someone who has that friendly open attitude in terms of meeting with you and not waiting for you to be perfectly buttoned up and lined up in terms of being ready to go. So that's really encouraging. Cindy, Kim's referring some to down payment. A lot of times people think you need 20% down. But I'm hearing that that's not the case, 3%, 3.5%, maybe an equity share, that there's different options. Can you share a little bit about what's involved with getting a loan with less than 20% down?
Yeah, and I can talk about a couple of nuances too. I was already thinking about that as Kim was talking about down payments. So there's a lot of different variations. There's a lot of creativity going on in the market right now since the rise in interest rates. So I'm going to kind of highlight that for me, if that's okay. But obviously veterans, that's a zero down program. The veterans loan program is by far one of my favorite. It is an amazing tool for home ownership. It's got a lot of flexibility. So if you are a veteran, don't overlook that fact that you have that option if you were in the military enough time or served during the war. FHA loans, 3.5% down, super easy to get into, more flexible qualifying criteria. They just lowered the monthly mortgage insurance on that, so those payments are now more affordable. FHA loans can be combined with down payment assistance, so those are tried and true, been around forever. And then conventional, like Kim said, 3% down, but moreover, I want to talk about, like I said, creativity. There is PMI on conventional loans when you have less than 20% down, but there are different forms of PMI that can be paid in your monthly payment. It can be paid one time and bought out completely. We can try to negotiate that with a seller for you if you're short on funds. So lots of time and lots of creativity goes into our job today. And we want clients for life, like Kim was saying. I'm sure, Austin, that's your motto too. Once we have somebody, and whether they're credit worthy or not in the beginning doesn't matter to me. I'm not going anywhere. So if it takes me 5 years to get them into a home, it takes me 5 years and they ultimately succeed. So lots of options. Another form of down payment people use is their retirement accounts. You can borrow against them or withdraw them. Unfortunately, PERS is not an option for that. They don't allow that. But you can also get a gift from family members. So all of our loan programs allow for gifts. You can also borrow against a secured asset. I've had people come to me and they own a boat free and clear, or they've paid off their car. You can also borrow from against one of those assets for a loan, and that's acceptable. Credit card is not acceptable and personal loans are not. It has to be secured. But again, lots of creativity. That's why you want to be with a reputable lender that's done it for a long time, like all of us, and really knows how to structure it best for the consumer.
And on that point, I would also recommend, not necessarily going with an e-lender, but, really talking to someone local. We have a small enough community that people are really guarded about their reputations, and they are going to be, very supportive and helpful. I would really recommend, even though a lot of the work that you might do might be online, if you want to be able to go and sit down with someone or talk to their manager, that's an option. And the lending, can be pretty complicated. So particularly as a first-time home buyer, I would not recommend that. I would recommend going to a local loan officer. And again, that's one of the benefits of our small community, that's available to you. So I guess that leads right into a question for Kim. How do you select a lender? What do you look for in a lender? Choosing a loan officer? Do you shop by interest rates? You call around and just ask what interest rates are and then go that way, or are there factors? How do you know how to get started in that process?
I am a big believer of getting a referral. So if you are working with a realtor, normally they will refer you, 2 or 3 names. Call, interview them, ask questions. If you have coworkers who recently have bought a home, you want to ask questions with your coworkers or your close friends and ask them about the process. Was the loan officer available on nights and weekends when you had downtime? Did the loan officer get back to you, fast enough, or did they go silent for a couple of days? Referral, it's really important. And it's really important, I think, when you're shopping on a new home, on a purchase, to work with a lender in the local area or local county. We know a lot of the realtors, and once you've established a reputation in your area or the county, the next county over, they'll see your name and they know that you've gotten the job done, and that if you're issuing a pre-approval, that you're going to follow through and that the escrow is not going to fall out. So I do feel it's important, to interview, ask around, and do your diligence. Interest rates. Don't shop by interest rates. I mean, you can, and it's great to be knowledgeable and see where the market's at, but I could quote somebody an interest rate in the morning and it could move by 1 o'clock that day. And a common scenario that I had or have had over the years is when people are shopping rates, they'll call you on a Monday and then they'll shop with, call a different lender on a Wednesday, and they're not comparable. You have to talk to the lenders the same days. Plus, especially in today's market, rates aren't just where we look at a rate sheet. It depends if you're a first-time home buyer. It depends on the county you're in. It depends even on your income now. There has been so many changes where you can't just quote a rate. You have to ask a lot of questions to get the correct rate. So.
Well, it sounds like even if you were to call someone on that same day, the same afternoon, and get those rates, that there's so many variables that go into that rate that you may not be getting apples to apples information.
No, and I'm leery about online lenders. Over the years, I can't tell you how many times I've had a customer who got quoted something that was too good to be true. And, 30 days later, they came back and we ended up doing the transaction. So it delayed it, or 2 weeks before the escrow was supposed to close, we're doing a rescue deal because they got quoted something that wasn't real. So know who you're working with.
Yeah, that's great advice. Austin, so the lending market has changed as of late. And, we're seeing higher interest rates. I think sometimes that scares people off. I would encourage people not to be scared off by the higher interest rates, but are there strategies to mitigate these higher rates? How has the lending market changed? What do you see?
That's a great question. And some of the things that everyone's referred to are these big changes that have been happening at a federal level. So we have to remember that rates are not just general economics, right? Money costs more or less. There's a lot of policies, and that's of course what Ken's referring to with the it's your loan to value, it's your credit score. So I actually think, y'all, that it is a absolute wonderful thing to buy when rates are high, because that puts you in a different market than when it was in 2020, when everybody could get something cheap, right? And with everybody getting something cheap, then you're certainly going to see more and more demand, and you're going to have to close quicker. You're going to not be able to negotiate. Maybe the house needs repairs, right? It was absolutely bananas. So that lending market's changed in the past couple of years with higher interest rates, but it's actually better for clients. So the ways to mitigate these higher interest rates are things like a 2-1 buy down or a 3-1 buy down. And that's where the seller helps subsidizes, your mortgage payment in the short term. These are still fixed rate loans. To be clear, none of us are referencing any of those crazy banana loans that people did back in the day that got folks in trouble. That's not what we're referencing. So a 2-1 buy down is very simple. That, let's say if your rate is 7% today, the first year you're 2% below, right? You're paying as if it was 5. The second year you're paying as if it was 6, and then would shift up to 7% in that third year. There are more permanent buy downs, the long-term buy downs as well, that your seller can help offset. But I think the main thing to know is that there's a lot of creativity. And even though we're seeing interest rates tick up, there are so much more opportunity for buyers in this market. This has to be your right property, not like, will you take my firstborn child and please let me at least just look inside, right?
Which is what was happening when we had so many,
Which is totally what was happening when it was
offers,
multiple offers. Yeah.
Yeah. Yeah,
Right.
and that's such a hard place to be, because you come in, need to be bidding 50 to 100,000 over asking just to be competitive. And probably the higher interest rates are nowhere near that extra cost. So that's really good too. So you're saying it's much more of a buyer's market.
It's becoming more stabilized. I can't say that it's completely a buyer's market,
Okay.
if only that, here in California, especially here in the 805, we have not been building enough for decades, right? So we don't have this huge influx of supply. So if we are not building enough and people do not want to sell, right, then there's no supply coming on the market. So with demand to live here, because it's absolutely paradise, continues to be stable or increasing because other people are realizing that it's paradise, then you're going to see the prices continuously increase. So I dare not say it's a buyer's market, but it's a more balanced market overall. And one tip, I know you all referenced a little bit earlier too about, X amount of money costs X amount per month. I want people to remember that a 1% increase in interest rate pretty much equates to a 10% delta in your sales price, right? So if rates were increasing by 1%, it means you qualify for 10% less, and the opposite is true. Now, where that's important is that if you buy at today's level, and then when you refinance, you double win because you're getting today's sales price, not a higher sales price that would happen as rates go down, but then your interest rate's going to be lower as well in the future. And like Kim and Cindy said, we're clients for life, right? So we're going to make sure that you've got those opportunities when it does actually make sense for you to refinance as well.
Well, that's great. Now, is it usual for your lender to reach back out to you when rates have dropped and say, hey, maybe this is a good time to refinance, or does someone need to just kind of keep an eye on that? How does that work?
Well, I think communication is key. And at any time that any buyer, borrower, client has a question, you should always reach out because we want to make sure you have all the right answers. However, I can tell you every single person on this panel, I'm sure has a process in place. I know we do. I know Kim and Cindy are true professionals. So they have a process in place that when it makes sense, because what you see online, what you hear on the news, as you've probably guessed if you've been listening for the past 37 minutes, isn't necessarily real. So therefore, everyone's going to have a good place to reach out to you automatically, but there's always, always welcome discourse as well.
Okay, great. So not a buyer's market specifically, but you're saying that sellers are definitely willing to contribute to the transaction with perhaps a buy down or some, nice credit for closing costs or something that would make it much easier for the buyer to get into that property.
Get in and stay affordable. Absolutely, Corby.
Right, good. Such great information. Thank you. Kim, this is time for us to go to questions. What are you seeing in our questions?
Yes. Yeah, we have some questions. So the first question says, do you still need a unique pre-approval letter every single time you look at a house?
Austin, you're on the pre-approval question, so let's put that one over to you.
I think you do, right? Because you don't necessarily want to show the seller that you can pay more than what you're offering, right? And personally, our pre-approvals are always going to reference the timeframes to abide by your contract. And I know the ladies do this as well, right? If you're selling the seller, hey, I can offer you $750 for that house and close in 2 weeks, but your pre-approval letter says 830 days, that's not a great way to start off a relationship or negotiations. So it is absolutely imperative to make sure that you are getting an accurate pre-approval letter. And I want to add, and I don't want to speak out of turn for anyone else's policy, but in my world, we send the pre-approval letter to the realtor because we need to know who's making that offer on your behalf. Because again, it's our name on that line vouching that you're going to get that loan. So the pre-approval letter is written to match your offer and sent to your realtor directly.
Now, is there a cost to the buyer each time you get a new pre-approval letter, or how does that work? What's involved with that?
Absolutely not. So of course your pre-approval letter should be within the compounds of your pre-approval, right? In that instance I gave, if we're pre-approved to 750 and we want to offer 8, we need to have a discussion and figure out how we're going to get there. But there's no cost to generate those letters whatsoever. It's all about communication. So if you need it, we can generate it pretty quickly.
Great, thank you.
I think we answered this question, how to find the right lender. But is there anything else you want to add, or? I think we had a long question answer on that. But.
Yeah, I think there is an answer. And there's also some on our the online education tool that we have at Coastal Housing Partnerships website, coastalhousing.org. There are some sections that talk about questions that you might want to ask a lender or questions you might want to ask in terms of interviewing a real estate agent. So that might be a source to look at as well. And as well as all of the great suggestions that Kim had with her section on that.
And then do first-time home buyers have unique benefits for a home loan or purchasing a home? I think we touched on some of that, but
on that, Kim, do you want to give a little bit more on that, or?
Well, for the first time ever, you will get a better, if your income is for Ventura County, if you're below 138, 420, you're going to get a better interest rate than somebody who's already a homeowner or somebody who is a first-time home buyer who makes more money. So the agencies have come out and they're trying to make it affordable and open doors for first-time home buyers. So it's a little different to tell, to be quoting somebody a higher rate when they have a larger down payment. But I think they're trying to give the first-time buyer a leg up in today's market. So.
Okay. Well, that's great news.
And then this says, what about what if the VA loan doesn't cover the entire loan? Is there another loan that can cover the rest?
Cindy, would you take that one?
So VA loans are based on the veteran's entitlement amount. And I'm thinking maybe what Miriam was asking, if entitlement's been used, if you don't have enough entitlement to cover the purchase of the next home, no, there's not really a loan to cover the difference. However, VA only requires you to put in a quarter of the difference. So it's a pretty specific calculation. But if somebody is short, let's just say somebody's short $100,000, which is a large number, instead of having to come in with that entire amount, they only have to come in with 25,000. So it's only a quarter of the difference. There's also a lot of myths and people misunderstanding VA. They think you can only use it one time. When you do sell a home, you get your entitlement back. And so as long as you've sold that home or it was assumed by another veteran, then you still have all of your remaining entitlement available to cover the cost of the home.
No, that's great to know. Thank you.
Yeah, that's a great tip. Thank you. Next question, are sellers willing to help with interest rates because they are able to sell their property for a higher price? So it may not cost the buyer less in the long run.
Austin, I think that one's right over to you.
Okay. Yeah, that's definitely correct, Mr. or Mrs. Anonymous attendee, right? So this is where you're getting that contribution from the seller towards that temporary buy down, right? Because again, that seller typically needs X amount to walk away from. That's their proceeds of the sale. So perhaps it's cheaper for them to help you with a buy down than to drastically reduce the sales price. And then this way, it's going to actually help you as the buyer to be less in the long run, because as I mentioned, they're subsidizing it. So if you do refinance before that time frame that all the subsidy has been used, that actually goes down to your principal balance. And that's very, very beneficial to you so you don't lose at all.
That's great.
Great. Yeah. Feel free to add any more questions. Otherwise, I do want to let everyone know that we are going to be sending out the recording of this great webinar. That was really wonderful today.
I also want to remind everyone that we have a home buying fair coming up. Coastal Housing Partnership usually hosts a couple of home buying fairs a year. We had to take a break through COVID, but we're back. And our next home buying fair is Tuesday, April 11th. From 4:30 to 7:30 at the Marriott Courtyard, Oxnard. You can check our website, Coastal Housing.
I'm going to put that in. I'll put that in our.
Great. Okay. So yeah, there's a way to RSVP in there. Encourage you to attend. It's a great way to meet potential members of your home buying team. We do seminars throughout the evening. So there's a lot of great information there. So encourage you to attend. Kim, are you seeing any other questions coming in? If not, I've got a couple more questions for our panelists.
Okay, yeah. Also, if you could just make me a co-host, sorry, then I'll send that out.
It looks like somebody has their hand raised too.
Okay.
We're not doing raised hands, but if you could put anything in the chat or Q&A, we're happy to answer that.
Okay, Kim, you are now co-host. So there you go.
Great.
While we're waiting for more questions to come in, I'm just wondering we hear a lot of myths about the lending process and wonder if, each of you might share one myth and what's the actual reality of obtaining a home mortgage, things that you hear people saying all the time and you just think, wow, where did they come up with that? This is what's really real. Kim, can we start with you on that?
Sure. I think overall right now, I was listening to a podcast today and they were saying 70% of the renters right now think that they cannot qualify to buy a home. And that's just for the amount that people are paying in rent, you could qualify to buy a home. And it's really important to come in, even if you're a year out, 2 years out, come meet with one of us and let's look at your budget. Bring your bank statements. There's tools and ideas and tips that we could give you to get you ready to buy a home in a year. We don't want you paying somebody else's rent. We want you paying your mortgage and, growing your net worth for your family and your future. So,
That's a great one. And I highly encourage folks to do that. Is just go see a lender, make that appointment and see where you are. And oftentimes I find that people are ready to buy sooner than they think. They think, oh, maybe it's like 3 years out, or, I'm waiting for a promotion, or, whatever that thing that's going to happen until they paid off a certain amount of debt. And they find that they're ready to buy maybe within a year. So wouldn't that be a waste to find that out after the fact? So, find out sooner rather than later. So Cindy, what about you? Do you have anything that, you hear people saying that you'd like to dispel that myth?
I do. So the market's going to crash. Market's going to crash. The interest rates are too high. The market is not going to crash. We're over 130 million homes short for the amount of demand we have right now in the nation. Right, especially here in the 805, like Austin was saying, we are in such a high desired area where our prices are going to remain stable if they do. So we saw a little bit of cooling off in the fourth quarter, and now it is right back to where it was before. So sellers are a little bit more flexible, but prices are not dropping. And we are getting multiple offers on homes. So it is competitive. So you have to be patient. And I try to tell my people, take the emotion out of it. Don't fall in love first. Just be like, okay, I can make this place my home if it works out. But try not to get discouraged. But the market is absolutely, in my opinion, not going to crash.
Great, thank you. Austin, what about you? Do you have any myths you'd like to dispel?
Yeah, I'll pop in real quick because I know there's a couple other questions coming in. One of them is definitely the waiting for 20% down, right? It is cheaper to pay a mortgage than it is to save for the next level, right? If we're saying you're buying a $800,000 house, 5% on that's 40 grand, but the payment delta may be only like $200 or $300 a month. So if you save $200 a month, it's going to take a long time to get to 40 grand, right? So a lot of the down payment options that everyone's presented here, even if it's mortgage insurance or not, that's hugely, hugely beneficial. And then the other flip side is I want to make sure people are taking into account that there is huge tax benefits to being a homeowner, right? Like Kim said, we want you paying your mortgage, not somebody else's rent, building into your wealth. And what you can do is you can literally adjust your withholdings today to get more money in your pocket versus waiting till April 15th or I don't know, what are we on, November 15th now for extensions in California, just given with everything. So there's huge, huge benefits on that side. No one here is a tax preparer. You need to talk to your own person. Everyone here is a great Rolodex for tax folks. But I want to make sure that that's very clear because what we're talking about is the true benefit for you so that you don't get stuck thinking you have to wait for anything. We want to make sure people get the right opportunity at the right time.
Good point, Austin. I think that happens so frequently while people are saving up for their down payment. The price of homes is just getting away from them. So they kind of never catch up. So
absolutely
get in sooner rather than later. And the time to buy is when you can, essentially. So great. So it looks like we have a couple other questions coming in, Kim.
Yeah, so the first one is, if you're a commission-only employee, business owner whose income is different every month, how do you know what price of home you can afford?
Kim, would you like to take that?
Sure. It's going to depend on which program we're working with, but normally we're going to look at the last 2 years' tax returns. If you do have a down payment, we may, if you've been employed for at least 5 years, sometimes we could take 1 year tax returns. So, and right now that taxes are still being filed, if you're on an extension, since we're here in California, we would be looking back to your 20 and your 21 returns since your 22 have not been filed yet. So.
Okay, so there's certainly options for that. Someone who's on a commission is not going to be excluded from being able to get a home loan.
And it's sometimes worth talking to a lender before you file your 22 returns. There are certain things on your Schedule C that we could add back in and that could, make you qualify for more. So if you're not ready to do your 22 returns, but you are in the market, have somebody look at them and we could give you a little bit of guidance.
Great tip. Kim, any others?
Yeah, last one. Are there unique loans for purchasing a multifamily complex with the intent to live and rent units?
Cindy, do you want to take that?
Sure. Right now, the only program I think where, so with VA, you can buy multiple units up to 4. With FHA, you can do the same thing. With the down payment assistance programs, though, they typically don't allow multi-unit properties, they're only single-family condos or townhomes. So with the conventional, it's typically 20 or 25% down, maybe even more when you get up to 3 or 4 units. I don't know that this is going to happen, but I kind of feel like we are going to see some subsidizing in that area too by the agencies, just to encourage home ownership in general. So if the homeowner owns one of the units that they're living in, or lives in one of the units they own, they're more likely to rent at fair market value the other 3 units or the other 2 units or the other unit. So hopefully we'll see that down the road. That's just a hunch, but not guaranteed.
And Austin, do you see that varying by area or region, or is that going to be consistent throughout the areas that we serve?
Did you
Me for the
Austin or me?
multifamily or Cindy?
Austin. Yeah, I
Okay.
was just thinking about, because you guys are in different regions.
Oh, yeah. Well, it's not going to be too different, right? Our guidelines are more or less the base for everybody. I will keep in mind, though, as Cindy kind of referred to on the FHA does allow for up to 4 units. The amount when you go over 2 units on FHA could be a higher down payment, because there's this weird thing where FHA that if they take over the property, like if they have to foreclose, they want to make sure the property cash flows, so that they want to make sure that there's a little bit of debt to rent ratio. That's very, very weird. However, that's something to keep in mind more from units, and that's less from an area overall. That's anywhere here on the 805 that we're serving.
Okay, so it's pretty consistent across the region. Okay.
Absolutely. Good question.
All right, thank you. Kim, any others coming in, or?
I don't see any more questions. I did put the home buying fair link in chat. If you guys want to register and attend that, we'd love to see you in person.
And we do have other webinars coming up. We do webinars each month, as well as I mentioned the online home buying education tool that we have that's on our website. You can check that out. It kind of takes you through the path to home ownership, regardless of what step you're in. And we are just available at any time to answer any questions you have about the home buying process. I cannot thank our panelists enough. This has been amazing information, so encouraging. And I would encourage everyone to take that step of just picking up the phone, calling a lender, see where you are in terms of your readiness, and get a game plan together. So thank you so much. All right, bye-bye.